We'll just wait a minute so people can get admitted into the webinar. Okay. Okay, good. I think we can make a start. Okay. So good afternoon, everyone. Welcome to this APSA webinar. APSA, as you know, is an industry association for structured finance industry in the Asia Pacific. We welcome those interested to join us as members to apply to join us. The details of our membership application will be set out in the Zoom chat. So my colleague here will type it out in the Zoom chat for you. And today I want to thank you for joining us for this timely conversation on stablecoins at the intersection of finance, technology, and policy. Over the next hour, we will move beyond the headlines to examine what high-quality fiat reference stablecoins look like in practice, how the new regulatory architectures in Hong Kong, the US, and Europe are reshaping market structure, and what it will take for these instruments to become reliable, boring plumbing for payments and tokenized markets. We have a superb panel today. Together, they span policy, legal structuring, and technical assurance, exactly the mix we need to translate statutory text into real-world operations. I will invite each of them to briefly introduce themselves, starting from my colleague Karen.
Hi, I am Karen Lam. I'm a partner at the Simmons & Simmons Hong Kong office and head the Hong Kong securitization and derivatives team.
And may I invite William to introduce himself? William?
Yes. I was muted earlier. So, hi everybody. I'm William G. I'm a chartered accountant by profession, but specialize in technology, emerging technologies. I've been working in the area of cryptocurrency, blockchain, and various forms of digital asset since 2014 or around that time. So really happy to join the session and discuss this very interesting topic.
And Ijeoma?
Hi, everyone. Ijeoma-Okoli. I'm a senior fellow at the Elsevier Center, Elsevier Romani Center for Business and Government at the Harvard Kennedy School. I'm also a strategic advisor to companies that are building in the blockchain and digital assets arena, both in Europe and in the US. I've been looking at this area since 2017 and advised JP Morgan on the design and rollout of the global risk management and governance framework for digital currencies globally.
Thank you, everyone. And my name is Kingsley Ong. I'm the Secretary General of APSA, and I'm also a partner at the international law firm CMS based in Hong Kong. So with that, let's start our discussion. So our discussion will start with today we'll discuss where the demand is strongest and what use cases are already working. Then we will go deeper on contrasting the regulatory frameworks in Hong Kong, the US, and Europe before turning to operational issues and also political considerations. I hope this webinar will provide you with concrete insights that you can take away to your organizations, what to build, where to build it, and how to build it safely. Stablecoins is not a monolith. Policy is converging on particular species, which are fully reserved, par-redeemable, non-interest-bearing tokens designed for payments and settlement. that convergence around reserve quality, transparency, AML sanctions compliance will determine who can issue, who can distribute, and which networks gain credibility. With that, let's dive in to today's discussion. So I want to start off with a first question to my panelists on will each one of you be able to name one misconception about stable coins that you want that you most want this audience to leave behind?
Yeah, maybe I'll start first, Kingsley.
Okay.
So I think maybe a lot of people, when they think of stable coin, they think of the crypto world. And stable coin might be the first step when you convert fiat currency into digital currency and then using that to buy things like Bitcoin or other types of cryptocurrencies. And it's kind of like a intermediate step to investment in the crypto world. I think what we're finding increasingly, though, is that stablecoin market itself is growing into quite a large market in its own right. I think JP Morgan Global Research has, in September this year, mentioned that the US dollar denominated stablecoin market now is around 225 billion. US dollars in size. So not a small amount. And that represents 99% of the global stablecoin market. And I think what people have been finding is that people have actually been holding on to stable coins instead of using it purely as a medium for converting into other cryptocurrencies. Some people, investors, have actually been holding on to these. And so I think the question then arises is what to do with these stablecoin holdings. And besides conversion into crypto, other crypto or payments, can there be more use cases for this asset class?
Thanks, Karen. Ijeoma?
I guess not a whole lot of misconceptions, but I think there are people who are already debating that stable coins are not cryptocurrencies, and that's not correct. They are. Any digital representation of value that is cryptographically secured on the blockchain is a crypto asset. So I think people the name crypto in some places is a little tainted, and so people are trying to kind of separate stable coins from the rest of the cryptocurrency market, or crypto assets market, but it is crypto.
Great. And William?
So I come in with two tiny snippets of I would say interesting facts. The concept of stablecoin actually existed well before blockchain came into place. Though if those of you who are familiar with Chinese history, way back, thousands of years ago in Tang Dynasty, there are these instruments, financial instruments that are actually issued not by the emperor, not by the states, but actually by merchants to make life easier. So various terms, in the old days, like feiting, flying money, to the more recent, the paper notes. These are all, in fact, forms of stable coins because they represent a unit of the official currency. Uh, Everybody heard of NFTs. Well, basically, it's the same technology. It's just a piece of code. And so, what is it? It's a piece of code within a particular program. So, something that people may be interested in.
Very interesting. Thank you.
Oh, and yes, Kingsley, one more point.
Yes.
All these issuer of these stable value instruments in China, look back in the Chinese history. In the end, they all failed, sadly.
Okay. Okay. Well, on that positive note, William, maybe we can talk about the current market overview. I think the audience will be interested in the current market overview. So, what benefits do fiat reference stablecoins deliver today that conventional rails such as credit cards and SWIFT and chats struggle to match in Asia?
I think this is not just an Asian situation. This is global because stable coins operate in a global context. Uh, 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 when people talk about stablecoin, they say there are various benefits. It's faster, supposedly cheaper, decentralized, so you do not have to rely on Swift or any other players. Uh, More resilient because if a particular operator kind of goes down or the line drops, you will still have something somewhere because it is supposed to be built on the blockchain ecosystems, et cetera, et cetera. The subtle thing, in terms of operation, as Karen mentioned, as of this point in time, stablecoin is actually more efficient when you are dealing with digital native related transactions. So you use USDT to buy Bitcoins because they're all on the blockchain is digital native. So digitally digital, you can actually connect and it's actually very fast. If you get a stable coin that's issued on the Ethereum blockchain and your asset is also on the Ethereum blockchain, it makes life very easy, in that context. In reality, when you are dealing with transactions, particular retail transactions, business transactions, it gets more complicated. So today we are seeing major credit card companies, other financial players getting into this domain, offering capability to support stable coins in terms of using them in transactions. Uh, the benefit will be availability because supposedly it's 7 times 24. It is global, so you can actually do global remittance. Uh, there is, however, the last mile to consider because let's say if two companies in different countries settled in using a stable coin denominated in a particular currency, ultimately the recipient of the amount will still need to pay their staff, will still need to pay utility bills and so on in their home currency. So if it is a US dollar stablecoin and they need some cash in a different currency, you still actually have that final translation, in terms of currency translation. So you need to like off-ramp the stablecoin back into fiat and then convert the fiat into your home currency. There is still something in there, and so when people look at the market, on the one hand, it's something that could offer great benefits, but on the other hand, when you actually come to use it, you really have to look at the operational side.
Mm, mm. Interesting, interesting. And where do you see the strongest near-term enterprise demand in Hong Kong and elsewhere?
Um, it's the natural place is to do with virtual asset related transactions. So people talk about RWA tokenization. We are now having more of these virtual asset related products on offer. Uh, in Hong Kong, we have licensed virtual asset exchanges, and so stablecoin usage, these virtual asset platform then becomes a natural place for using stablecoins. Um, when you extend that to say, well, can I actually use stablecoins to do my retail payments? Can I use it to pay off my company purchases, B2B transactions, even cross-border transaction? That then the complication kicks in. Address including and not limited to the currency denomination of the stable coin, which one to use, which platform you choose to operate on, because stable coins indeed are actually issued on a number of different platforms. It's not just yourself; it's the other side of either party of to the transaction. So there are some, operational consideration, but we are now, the immediate starting point is on the virtual asset related products, in terms of investments and so on. We are trying to extend it to other usage, but that particular path is very different to using it to buy virtual assets or virtual asset related products.
Thanks, William. And Karen, can I put this question to you? So from a securitization and derivatives vintage point, which you are an expert in, what is the current usage of stablecoins for the digital cash settlement leg of digital securities and collateral transactions as compared to alternatives such as tokenized bank deposits and CBDCs?
Yes, Kingsley, that's a very interesting question. And I think drawing on from what William said just now, I think the use case for stablecoin is probably higher in situations where the investor base is already, for example, investing in virtual assets. So I think the types of deals you might be looking at would be private transactions, private structured products, referencing virtual assets, other cryptocurrencies, etc. I think, and generally, these may be distributed or targeted to certain professional investor base that may already be investing in cryptocurrencies. So maybe the kind of younger generation, high net worth investors. I think there is some potential there because some of the issues with on-ramping that William mentioned may not be so much of an issue if the investor base is already holding virtual assets to start with, and they're looking for ways to get a higher yield or return on their existing virtual asset holding. I think where it's more challenging is where you're looking to use stablecoin as the digital cash settlement leg for, I think, larger, more public digital securities issuances. So I think there have been a number of innovations in recent years in the public capital markets where various jurisdictions have been testing and doing proof of concepts regarding digital securities. And previously, I think a lot of that has been limited to the security side of the settlement. Increasingly, however, we are seeing more transactions where different types of digital cash are being used for the cash settlement leg as well. And I think the idea is, like William said, to achieve a faster settlement if both the digital securities and cash legs can be done on chain. And however, I think recently what we have seen so far have involved other types of digital cash assets, such as the wholesale central bank digital currencies. I think in this year alone, there have been various initiatives. So, for example, the Hong Kong government just issued their third digital green bond this month. And for that, the Hong Kong dollar and CNY renminbi denominated issuances have a settlement option for central bank digital currency, so ECNY and E Hong Kong dollars. Again, I think in Europe, there have also been initiatives to use wholesale central digital currency for settlement. And so, whereas I think for stablecoin, that has been less, of a focus at the moment. And I think that also partly has to do with some of the factors that William mentioned just now. So, for example, the fact that holdings of a stable coin at the moment are probably just focused on certain pockets of the market. For example, existing crypto investors or people who have been using it for payments. And so, if you are to use stable coin for large scale securities transactions. Again, you need to think about how to on ramp and which stable coin to use and different fallbacks. And I think whereas for wholesale, central bank digital currency, you have maybe less of those issues because you're essentially dealing with a digital form of central bank money. And I think a government policy has also been, pushing for use of that form of digital currency. I think another alternative that's worth mentioning as well is tokenized bank deposits or cash deposits. And as well as tokenized money market funds. And this is also another alternative for digital cash settlement. And essentially, investors would park the funds with a bank like a deposit that would be tokenized and then used for cash settlement. And the way that is regulated is similar to other bank deposits, except that it is in tokenized form. So again, I think this is something that we have seen people using, so I think in the public market space, stablecoin needs to compete with these other options for digital cash. And I think particularly given that the stablecoin legislation has only been being put in place, this year. For example, Hong Kong still has yet to license their first stablecoin issuers, and I think similarly in the U.S. legislation has been in place, but we haven't got properly licensed issuers yet. So I think that is still lagging behind a bit. But with the legislation in place and more regulation of stablecoin, that may lead to increased or wider use of stablecoin. And so it may be that in the future, this could increasingly become an option for digital cash settlement of capital markets transactions, including securitization.
Mm, mm. Great, great. Thanks so much, Karen. So there's a lot of potential there. Now, before I go on, I just want to remind the audience that if you have any questions, you can ask at any time in the Q&A box. Feel free to type your questions in the Q&A box, and we will try and address those questions towards the end of our webinar. So please feel free to type your questions in the Q&A box. Now, the next question I have is actually for Ijeoma. So, Ijeoma, can you tell us about the current stablecoin transaction volumes, the concentration among users, among issuers, and the geographical usage right now? Thank you.
Sure. Hi. But before I dive into that, I just kind of wanted to give people a sense of where this is coming from and how and where we are now. So stablecoins essentially, they're only about 11 years old, and they came about as a result of the fact that unbacked cryptocurrencies are extremely volatile, and then going back and forth between the traditional banking sector to on-ramp or off-ramp was time consuming. And so stablecoins were developed to park value in a stable way on the chain, on blockchain. But what has happened since then is that they've increasingly been used for not just trading and to park money on the blockchain, but they've been used for payments, global payments across the world, simply because you can move money around the world at the speed of light, right? And it's pretty cheap to do it versus trying to use ACH or any other method. It's cheap compared to using credit cards or going through, a bank-to-bank transfer. What we also see is happening in relation to stable coins is that it actually is being used as the crypto assets ecosystem is growing in sophistication, because now we have not just people trading cryptocurrencies, but with the development of smart contracts and the Ethereum blockchain and smart contracts in 2015. You see people now being able to engage in transactions like loans. So there's a relatively vibrant loan sector on the blockchain, and the way that they move value is by stable coins, and then other unbanked crypto assets like Bitcoin are used as security for those loans. And so I thought it was important to just give that background before I kind of talk about volumes and stuff. So a lot of this, what's happening right now in terms of the stablecoin transaction volume is in relation to the trading on chain, and most of them on centralized platforms as opposed to decentralized finance. So there are estimates that in the last year, approximately last 12 months, that the stablecoin payments has hit about $9 trillion, which is pretty significant. So it's rivaling, traditional market players like Visa and PayPal. In terms of who dominates the stablecoin market, approximately 99.9, let's say, percent of the stablecoin market is US dollar based. It's US dollar pegged, I should say. And the two largest players are a company called Tether, which has moved around the world. Currently, it's headquartered in El Salvador, and Circle, which listed on the Nasdaq Stock Exchange earlier this year, which is based in the United States. So Tether essentially has about a little over 60% of the market, and USDC has about 23% of the market, and all the others, there are lots of others, comprise the rest of that market. So in terms of geographic usage, it's basically these are moving all around the world. And just because it's dollar based doesn't mean that it's solely in the United States. People are in a way, stablecoins are further dollarizing the global economy. What we're also seeing now is that stablecoins are beginning to be used in global trade. So it's not just retail, but it's institutional as well. Kingsley, I don't know if that sufficiently answered your question.
Oh, very much. That's very good overview, Ijeoma. Thanks so much. Um, so I guess with that, I want to move on to regulation. And Ijeoma, I wonder if you're able to comment on the European stablecoin regime and the US Genius Act, which the Trump administration has pushed as the beautiful bill. Is it beautiful act? And maybe you can comment about the different policy aims and the supervisory architecture of these two jurisdictions, and which elements do you think is most likely to shape global standards?
Sure. So the EU Markets in Crypto Assets, MiCA Act, was the first of the two. MiCA has been discussed in the European Parliament and Commission for quite a long while. It only came into effect last year. The first provisions only came into effect last year. The impetus for this was basically, I don't know if folks remember when Facebook tried to launch a stablecoin, and regulators around the world got a little scared, and so MiCA, the kind of origins of MiCA was putting in place something to ensure that the European market was protected, because prior to that, regulators generally just ignored this market. So as Kingsley mentioned, the Genius Act was passed and signed into law this summer, but it hasn't taken effect yet. And so the agencies, particularly the Treasury, they're just working through the provisions to put in facilitating regulation, but it is there. Just on the EU MiCA. So EU MiCA essentially characterizes stablecoins. It doesn't use the term stablecoins. It uses the term asset reference tokens and e-money tokens. So e-money tokens, those are they have to be stable as well, but only credit institutions, for example, banks, can issue those e-money tokens. And e-money tokens pre-existed MiCA. But MiCA also put in place another type of, they're all stable coins, another type of asset called asset reference tokens. And these terms are not used anywhere else but in the EU. And I think they're extremely confusing. So asset reference tokens can be issued by a non-bank issuer. However, the issuer must be in the EU. And so that's kind of, I think, for me, that's something that the US doesn't do. The US will allow non-US issuers to actually have stablecoins in the market. However, they would have to register with a US federal regulator, the Office of Control of the Currency. So that's one difference. Some similarities that they have is that they're all going to be required to have reserve assets that are high quality liquid assets, both of them. They also both are not going to allow issuers to pay any interest. And this is, I think, a concession to traditional banks because there's a fear that if stablecoin issuers are allowed to pay interest, that will divert deposits away from traditional banks. And of course, if banks don't have deposits, of course, they can't provide loans. And so that destabilizes the credit markets. But anyway, neither of them allow the payment of interest. Where they differ, I think, is in terms of how restrictive they are. And the US is a lot more flexible in terms of what issuers can do. And I'll give you an example. One major example is that the EU MiCA essentially requires that reserves, at least 30% of the reserves of any stablecoin, be deposited in an EU bank. The US doesn't have that requirement. Where that threshold increases to 60%, where stablecoin issuer is considered significant. And significant essentially means that they have maybe 10 million issuers or 5 million in market capitalization. And if you look at the top two stablecoins right now, they've blown past that, right? So that will mean that 60% of their deposits, if they chose to register in the EU, 60% of those deposits will have to be in EU banks. And why is this a negative thing? Well, stablecoin issuers, when they developed and they continue to do so, is that basically they take your dollar or your yen or whatever currency that you give them, and they provide you with the relevant stablecoin, and then they take those and then they invest them. Right. And basically everything that they earn on those investments, they keep. They don't give you anything. And by law now, they don't have to give you anything. It's actually, they're prohibited from giving you anything. If all of a sudden 60% of what they take from you is put in banks and in the EU and the US, particularly in the US, banks pay 0.1 interest or 0.2 interest. It's basically nothing. So they're not making any money on that. And so it's potentially business killing. And what has happened in the European market, the largest stablecoin issuer, which is Tether, has pulled out of the European market before these rules came into effect. What the second largest one did is essentially carve out, set up an issuer in the EU, and that issuer is just catering to the EU market, and then the rest of the world, the stablecoins can come from the US entity. Not directly, of course, it doesn't provide direct access to it, but through intermediaries. So that's what essentially the difference between, one of the major differences, I think, between what the EU has put in place, although it was the first, and what the US has put in place. The US is a lot more flexible in terms of allowing issuers to invest or to do what they want, as long as there's adequate risk management, adequate anti-money laundering, counter-terrorist financing procedures and processes. The U.S. is essentially going to be allowing them to kind of be more flexible in terms of what they do with the money that they take from people.
Thank you, Ijeoma. That's a very insightful, excellent overview. Can I ask, do you see these two regimes complementing each other or competing with each other?
They're competing for sure. Everybody's trying to be President Trump has said he wants the US to be the crypto capital of the world, right? And prior to Trump coming into office, you saw other jurisdictions around the world when the US actually was relatively non-friendly to the crypto asset sector. You saw other jurisdictions trying to kind of compete. Right now, the US is, doing whatever it can to be the crypto capital of the world. So it's definitely a competition for sure, no doubt. And right now at this stage, it seems like the US is winning because they're trying to make things pro-innovation. Pro-innovation is the theme of the day. Pro-innovation, but taking into consideration investor protection, financial stability. That's what the banking regulators are focused on, financial stability. The markets regulators are more focused on investor protection, but all of them are focused on making sure that you can't use the US pro-innovation regime to actually commit fraud. So they're still focused on, people who are looking to commit fraud, and they will prosecute people. That's the message that's coming out. So it's a competition for sure, no doubt.
Mm-hmm. So in this competition, are there any spillovers that you see for Asian policymakers and Asian participants?
I think one of the things that the US has essentially said, and this is embedded in the Genius Act, this ability to allow foreign, or I should say non-US issuers into the US market. But one of the things that this idea is going to allow the Treasury to do is to cooperate internationally with jurisdictions around the world to come up with whatever it is, because this is a global market. And I think, the drafters of the Genius Act and the people who have been championing it recognize that this is a global market. And so the Treasury Secretary is provided with the power to actually go out and talk to people, go out and negotiate, go out and come to agreements with jurisdictions around the world, recognizing that this is truly a global market. But I think just generally in terms of the digital asset sector, I think what the US is kind of using its strength, its power, its position, its influence in the global markets, it's trying to get the rest of the world to kind of not put in place things that are business killing, not put in place things that are crypto assets unfriendly, and just this touches upon stablecoins, but it's not directly related to the topic. But this kind of just happened, so I thought it might be relevant. The Basel Committee on banking supervision that many of you know, they came out with their requirements for crypto asset exposure in relation to crypto asset exposure a number of years ago. One of the requirements that they put in place was essentially that if a bank held or had any exposure, so the exposure could be loans, exposure could be, them holding it. If certain types of crypto assets, and I'll give an example, Bitcoin, that they had to hold 100% capital against that. So no, that literally is anti-business, completely anti-business. And these rules or these requirements are supposed to come into place in January, so in literally 2 months. What has happened in the interim? Well, the new US regime with the new vice chair actually at a conference earlier this month basically said that these are not realistic and the US is definitely not going to put this in place. And you could have seen that before because the US made no steps towards putting, any of this in place before, but now it's explicit. And what has happened since then? The president of the Basel Committee has essentially said they're going to reconsider it, right? So these are things that's supposed to be coming into place in January of next year. But right now, 2 months before, Basel is essentially saying they're going to reconsider. As to what it's going to look like, no one knows. But I think this is an example of the U.S. essentially, using its pro-innovation stance to get international bodies to actually think differently. Don't fear this thing, right? There's nothing to fear if you put in the right controls in place. There's nothing to fear. Allow people to do what it is that their customers are asking them to do, or they themselves want to do. So that kind of relates to this slightly, but it's just kind of more general in terms of crypto assets.
Thank you, Ijeoma. Thank you. And maybe I'll turn the next question to William. So, William, are you able to give us a brief overview of the Hong Kong regime for stablecoins? Because Hong Kong has also introduced its own stablecoins regime as well.
So yes, Kingsley, I'm just kind of going because I know Karen is from the professional legal profession side. So Karen can talk more about the legal profession, the legal aspect to that. I'll give a more a high level kind of aspect to this, and following on what Ijeoma said. The interesting part is what is the regulation seeking to achieve, and that is the important point. The Hong Kong regulation is actually more on the protection of users, and so if you are holding on to something that purports to be equivalent to $1 Hong Kong, do you actually really have the asset to back that particular token? And do I actually holding on to $1 Hong Kong, in that context? So in the Hong Kong ordinance, the terminology focuses on fiat referenced stablecoin. Similar to a number of other jurisdictions, that's the position that they take. Step back a bit. There are different types of stablecoins. So generically, there are two major types. One is where the stablecoin is backed by some form of asset, and those assets are traditional assets. The second type is that it is actually either backed by crypto assets, which is in itself volatile, or it is actually using algorithms to enable that balancing to maintain that stability. So this is all about coding, about supply and demand, and so if the price drops, you reduce circulation. If the price goes up, you increase circulation, and that is supposedly to be done dynamically through the algorithm. The latest crash, Luna crash, the Luna stablecoin, that was one that falls under the so-called algorithmic stablecoin, and it was proven that it's actually the most susceptible to kind of adverse market forces, and so a lot of the regulator focuses on asset-backed stablecoins. Now, asset can be fiat currency, or it can be any form of other asset. You can have gold and whatever, and just translate it to a particular value and maintain that stability. So in Hong Kong, the law talks about fiat reference stablecoin. It's not Hong Kong dollar stablecoin. It's fiat reference stablecoin. That means it can be denominated in Hong Kong dollar, or it can be denominated in another currency, or indeed a basket of currency. The regulation allows that to happen. And the obligation to the issuer is actually to maintain the asset so that is sufficient to basically meet their obligation. The interesting point about that is exactly, how do you achieve that? One aspect to make sure you have a sufficient reserve asset and is safe is to actually direct them in terms of what type of investment you can kind of use it for. Both Karen and Ijeoma mentioned regulations in that context, and so for Hong Kong, it's the same. You have to invest in high liquid assets. And one example of that is actually government bond. And this is basically, most stablecoins will have a portion of their reserve asset invested in that. the interesting point is about how much you should invest in which class of asset. Now, in Hong Kong, the regulation as of this point in time doesn't specify any proportion. Ijeoma mentioned about the US approach. I was reading the Bank of England's consultation paper, on this issue. Interestingly, the way that the Bank of England, took was to say the backing asset up to 60% in short-term UK government debt. That is actually a determined proportion, which is actually, pretty high. But that's not it. 40% of these backing asset as unremunerated deposits in the bank. Now, that means, as was explained earlier, the issuer don't actually get any money out of it. And that is the situation. So balancing the whole licensing and regulation aspect is to balance the all these risks. You can be kind of crypto friendly or innovation friendly, and kind of allow more flexibility in terms of how you can use the reserve asset versus a more protection, or rather the consumer protection. Not investor protection, because stablecoin is actually not for investment. Its value is stable, it doesn't go up or down, and so it is actually not for investment, but more for consumer protection. You're making sure that there's sufficient money to redeem these assets, if indeed that there is a need. So these are the kind of way that regulator will balance. The regulator hasn't actually set any limits per se in terms of how much you can hold. In the Bank of England consultation paper, there was mention about holding limits for individuals and also for corporates. In Hong Kong, it is still a bit flexible. It's up to the issuer to set limits and to allow consumers to set limits on their transaction, a bit like what you do on your banking app. You can limit your transfer to unknown third party to a certain limit. That's essentially for safety, so for security, and for your own protection. So these are the different kind of aspects to in terms of current regulation when they're dealing with it. One important aspect is the regulation requires disclosure. Disclosure in terms of the types of reserve assets you hold. So which type, how much, and obviously, if the regulator wants to really play safe, you can mandate over collateralization. So if you issue $100, you have to hold $120 as collateral to make sure that everything is safe. Exactly how much, that it probably would be down to a case by case basis. So the issuer need to disclose that, and then need to publicly disclose their kind of asset holding, and also to get independent attestation to the reserve asset in terms of whether the value is sufficient, equal to, or at least equal to the amount in circulation. Now there are obviously technical and practicality implications on that. But these are something that we are working on. One of the tasks that I'm involved in is supporting and working with the local accounting institute, having a dialogue with the monetary authority in terms of what the attestation report should look like, how it should be done, the basis of valuing all the different types of assets. You may think, well, $1 is $1, but when you actually convert that into different types of financial instruments, you actually, based on accounting standards, you have different methods of valuing it. So do you value it on market value? Exactly how do you do it, and so on. Determining the amount that is actually in circulation. And if the stablecoin is designed to um, kind of enable users to make use of it more conveniently, it could actually be minted on multiple blockchains, not just one. Both Tether and USDC Circle supports, I think, more than 20 for Tether, and also a similar number for Circle. So it's not just on one blockchain; it's actually on multiple blockchains. And so when you come to looking at liquidity issues and so on, it is actually not as straightforward as it may seem. So for Hong Kong, we don't know exactly how it's going to turn up yet because the license are not being granted as yet. We are looking to next year before the first stablecoin license will be issued by the authority. But in the meantime, we are working on some of these aspects and making sure that we have all the capability to support the regulation and the monitoring when it basically comes online.
Mm, mm. Thanks, William, for that comprehensive review of the Hong Kong regime. So with that, I would like to move on with to Karen. So Karen, we've heard just now that the Hong Kong stablecoin ordinance presumes par redemption for reference assets, and also we've heard that there's a ban on payment of interest to holders. So how will this affect design choices on stablecoin product and marketing and litigation risk?
Yeah, thanks, Kingsley. So, I think, as mentioned earlier, the lack of interest-bearing feature could result in investors preferring other digital cash alternatives. So, for example, people can also invest in tokenized money market funds, which would be able to generate a return. I think similarly, the reserve requirements, par for par redemption, and also some of the very stringent KYC requirements for secondary trading that are imposed on stablecoin issuers may also deter certain people from applying for a license because of the level of obligations imposed on them. I think particularly with some of the reserve requirements, if you're a traditional financial institution, a bank who would be able to hold bank deposits with a much lower reserve requirement, then it may be that doing a tokenized bank deposit or tokenized money market fund and using that for cash settlement of financial transactions might make more sense. So I understand, however, that for stablecoin, these features have been built in for protection of investors as well as stability of the market. So it may be that in certain use cases, people may look for other alternatives instead.
Mm. So from a securities issuer perspective, deciding between stable coins and other digital settlement options, what are the relevant considerations from a Hong Kong regulatory perspective?
Yeah, I don't think it's so much a Hong Kong regulatory issue because if you're a digital securities issuer, I think you're not responsible for the issuance of the stable coin. So it's more the operational considerations that we talked about earlier that will come into play, particularly the ease of settlement issues. And I think, for example, each digital currency option currently have their pros and cons. For CBDC, for example, a lot of times these are still currently limited to wholesale bank funding. So not a lot of people have access to that. So the settlement may be limited only to between financial institutions. Whereas for stable coins, again, I think the regulations are still fairly new, and we have some of these limitations regarding interest, etc., that we talked about and on-ramping. I think also people would look to ideally have the digital securities and the digital cash on the same platform. Otherwise, if you have the two legs sitting on different platforms, then additional steps will be required in order to achieve a delivery versus payment, which then also results in delayed, or slower settlement or more complicated settlement, and that kind of defeats the purpose of having a digital settlement and the reaching the ideal of the 24/7 instantaneous settlement that people have been looking for on blockchain.
Mm-hmm. Thanks, Karen. And are you able to comment a bit about the legal challenges that participants face to bring tokenized securities and stablecoins live in Hong Kong transactions? For example, you mentioned title and things like, but what about insolvency and client asset rules? Does this have an impact? Sorry, Karen, I can't hear you.
Hi, can you hear me?
Yeah, now I can. Now I can.
Okay. Yeah, sorry. Yeah, I'll be quick since we're almost at time. But I think given stable coins are also a form of cryptocurrency, as we just talked about, so similar legal considerations for crypto assets will need to be considered. For example, the legal nature of such assets. And I think this has been subject to a lot of discussion in the past years, but we are getting more legal certainty that this can be considered as a form of property. I think in Hong Kong there has been case law in the form of Regate Coin, which also confirms that cryptocurrencies can be a form of property that is capable of being subject to a trust. So I think there is increasing legal certainty around stable coins as well as other crypto assets under legal framework. And also, I guess the industry is also has also been working on updates to various legal opinions supporting various different transaction types to cover different forms of digital assets as well. So I think once these are in place, then there will be much more legal certainty. And of course, pending, I guess, standardized legal industry opinions, legal experts can also provide, bespoke advice to support the transactions that parties are looking to enter into. I think finally on client asset rules, there will be some changes, I think, coming into play with the, a virtual assets custody regime in Hong Kong, for example, that has been subject to consultation. I think once that is in place, then there will be more clarity around how virtual assets custody will be handled and the client asset protection that will come as part of that.
Okay, thank you so much, Karen. I know we are running a bit short of time, so William, do you mind if I ask you this question for your brief reply, which is, Ijeoma said that 99.9% of stable coins are USD linked. So, in your view, is there any chance for Hong Kong dollars reference coins to be viable at scale? William?
Can you hear? You can hear me, right?
Yeah.
Yeah. It depends on the actual usage. So if we used Hong Kong dollar denominated stable coin for, say, settlement in Hong Kong in relation to various forms of assets, tokenization, and so on, that's perfectly fine. If you want to do it, use it for international payment and remittance. It's not about you, it's about the other party. We in international trade, we agree in the contract, how do you pay and in which currency do you actually make the payment? And so all of it is actually not from my perspective, it's actually from the particular use case and how it's going to be used. In any case, as I mentioned earlier, the Hong Kong legislation also enable you to issue any other currency, in terms of stablecoin. So it doesn't have to be Hong Kong dollar. And so in theory, you have to do that. Now, the other aspect is actually to layer add another layer on top to enable your Hong Kong dollar or whatever denominated stablecoin to switch to another stablecoin for that payment. It's just adding one more layer, to the infrastructure. But if you do that, then you may actually take away some of the intended benefits in terms of speed and costs and so on, because you are also leveraging other players. And whichever way you do, you are actually using a centralized kind of model rather than a kind of a decentralized model where the blockchain technology was originally designed for. And so it is not a matter of currency, whatever policy and so on. But as you know, Hong Kong dollar is pegged to the US dollar, and so in one sense, Hong Kong dollar is a US dollar stablecoin. So it all depends on how you see this, and one argument is it's pointless issuing a stable coin on based on a stable coin, but we are where we are. It is innovation in the technology term, and so let's see how we can actually make it work. And obviously from the user point of view is efficiency, cost, and so on, and also security. In the regulators from their angle, obviously is AML, KYC, and kind of a consumer investor protection. And so the dimension is different. The two sides need to kind of come together and achieve a good balance, going forward.
And William, do you think that the Hong Kong regime advances or complicates mainland policy objectives, given the likely US dollar stablecoin usage in Hong Kong?
Uh, I would probably reframe it in a different sense, because we are looking at different jurisdiction, different rules for different jurisdiction. So MICA is somewhat different to Genius Act in the US, different to what the bill Bank of England is proposing, obviously different to what Hong Kong has enacted. And obviously in China, as everybody knows, China prohibits cryptocurrency, and stablecoin is actually a form of cryptocurrency, so it's supposedly not allowed in terms of issuance and so on. And so for companies seeking to embrace this technology, and if that company, in terms of its operational footprint, covers multiple jurisdiction, it is essential for the company to understand or the subtlety of all the different regulations in all the jurisdiction that it has business in, seek external advice from councils, and making sure whatever they do, is conform to laws and regulation. For organizations seeking to be issuers, this will be very tricky. For organizations seeking to be a user of stablecoins, the issue is on the other side. Can you actually convert your stablecoin back to the currency that you need? And so if you do this, and want to convert it to Chinese yuan in China or elsewhere, right now the off-ramp side will be very, very challenging. You may not be able to convert it, and therefore you are stuck. So you have to do it some other way, which basically defeats the whole purpose. So do seek advice on this usage. If a company is actually going into that particular sector.
Okay, because we are short of time, so I'm looking at the audience Q&A, and we maybe can take one or two questions. So um, uh, let me see. So I guess there's one question here. Are there derivatives linked to stable coins in the market currently? Are there derivatives linked to stable coins in the market currently? I don't know. Karen,
No,
have you seen that, or
no,
William?
no,
Oh,
because
okay.
it's not an asset, so you don't actually have derivatives on the stablecoin.
Okay.
Yeah,
You will never see that.
I guess that you might have it as a sort of cryptocurrency pair, such as like Bitcoin and a stable coin, but it wouldn't be a derivative in respect of the stable coin is in and of itself.
Okay. So another question, since you can't earn interest on your holding of stablecoin, Why would anyone hold them long term, except criminals? Ijeoma, you want to take that or?
Yeah, the whole purpose is remember I said it's to kind of hold value on the blockchain, right? When between trades, or actually now as a means of payment, or in the blockchain ecosystem to provide loans, right? So, this idea that crypto is used for criminals, cash is used by criminals too, right? I think it's not to excuse anything that's going on. I think a lot of work needs to be done to kind of clean everything up. But I think, treat all forms of all types of transactions the same, regardless of the technology being used.
Mm.
There are legitimate reasons for people to use crypto assets, and they do. Just because a handful of criminals also use it doesn't mean you get rid of everything. So, as I said, just in sum, people use it for loans, to transact, to hold in between trades, and for payments.
Mm.
And
Any other
just to
comments?
supplement that, just
Yeah.
Kingsley, just very quickly, it is a very efficient form. If you are talking about digital native transactions, you can actually achieve atomic settlement. DVP being the objective, and so it is actually highly efficient. We have Octopus in Hong Kong. We charge money into Octopus. So everybody's holding some balance in their Octopus card. It's not interest bearing. We use that, we hold it because it is convenient, it's useful. So this is purpose, rather than making money out of it.
And it's also like pay me and all that stuff there.
Yeah. But
Um,
payment is straight from your bank account, so that doesn't count. It's when you have to charge something. So Octopus is an example. You
hmm.
you you know charge it $5,000 and so on, but you are not getting any interest out of your 5,000.
Yeah, but I don't think anyone puts $5,000 in his octopus.
Oh, I've seen $5,000 balances.
Okay, I guess with that, because we've exceeded our time, so apologies for that. But I guess there are quite a number of other questions. We don't have time to go through everyone, but please feel free to reach out to us. Feel free to reach out to me at APSA, and if you want to discuss your questions, and we will try and revert to you and have a further discussion with the speakers as well. So, but at this time, I think it's appropriate for me to close, and I think just to summarize a few points that we have discussed today, I think first and foremost, I think we have heard that there is a clear center of gravity that has emerged. So the stable coin that survives regulatory scrutiny is a simple focus, one-to-one backed with high quality liquid assets, par redeemable quickly with in reference currency, transparent by design, strong AML and sanctions control. So that is the focus on the center of gravity. Secondly, I think architecture matters. So Hong Kong, the EU, US offers different regulatory architectures, so it's important for issuers and platforms to decide which one fits them best. And then I think the third point is operational excellence. It's really critical. The market rewards issuers who can demonstrate liquidity and without hidden risk and reserve assurance and all that stuff. And obviously there is competition, there's geopolitics, but even with this competition, the practical path forward is for everyone to coordinate the standards and transparency so that we can work efficiently together. And I guess with that, I want to thank my speakers for their clarity and their candor and explaining to us their knowledge. And thank you all for your participation. Thank you very much. And I hope to see you in future APSA seminars. Now, before you leave, there is a survey for that we would appreciate you to complete. So if you're able to complete that survey, my colleague Ada will show the survey QR code, and we'll be very grateful for that to help us to improve on future webinars and events. Yes, so thank you very much. If you take the scan of this QR code, we'll see you next time. Thank you to all my speakers as well. Thank you.